Hello, welcome to a video on income tax, yours, mine, and just about everybody's least favorite thing to talk about. In this video, we're going to determine how to calculate gross income, adjustable gross income, and taxable income, calculate federal income tax, FICA taxes, and problem solve working with sales students and taxes. Alright, income tax. That's a percentage of your income collected by the government to fund its services and its programs. Alright, typically it's a pretty big chunk of money depending on where you live. It varies state to state, even county to county at some places. Percent and income tax. How does percent come into this thing? Well, just like before when we talked about coming up with taxes involving percent, typically we've got some type of a tax rate and we calculate how much of our gross income, how much of our adjusted gross income can be taxed. And once we come up with our taxable income, we multiply by a tax rate, and that's taken out, and we have to pay that amount. So how do we determine all that? Well, the first thing we need to come up with is what is our adjusted gross income. So our gross income is what we make, like our wages and everything, earnings from investments, all the stuff that's coming into us. And then the adjustments are payments that we pay out to pre-taxed type savings plans, like annuities, IRAs, maybe something for your kids, but just adjustments, medical things, just stuff that comes out pre-taxed from our gross income. And then beyond that, we take our adjusted gross income, and to determine our taxable income, we take off exemptions and deductions that we might have, exemptions for ourselves, and then for dependents we can itemize and take out things like property taxes, things that we gave to charity, state income tax, mortgages, interest we paid on mortgage and students' loans, all kinds of different types of deductions that we can get if it exceeds the standard deduction. The standard deduction typically is a percentage of your adjusted gross income, and if your exemptions, if your itemized deductions are beyond that, then it pays to itemize, but if not, then you get the standard deduction which comes out. So after we've taken all that stuff out, we've got what's called our taxable income, and then we take our taxable income and we find out the tax rate, which tax bracket we fall in, and we remove that. We take out the things that we could take out because of our filing status, and the credits, like if you have kids and other things, medical expensive things that you can get back. That will be the amount of tax that comes out based on your taxable income. Alright, so let's get an example to kind of walk through this. So this is a single man, so he's going to file single. He's got wages of this much, $1,850 interest from a savings account last year, received $15,000 from winning on a TV game show. Right, and then he contributed this much to a tax-deferred savings plan, like an IRA or something like that, or 401k or something. And then he's entitled to a personal exemption of $3,800. Right, and then the standard deduction for him was his itemized deductions were not more than the standard deduction, so we're going to take the standard deduction for him. He paid interest on his home mortgage, and he paid $2,100 in property taxes, estate taxes, $1,855. Contributed $3,000 into charities last year. Okay, so let's come up with his gross income first. So we'll start with part A. So the gross income is his income that came in, the wages, the interest from savings account, and that game show winnings. Those three numbers right there are going to be added together to come up with his gross income. So that's where that's coming from. So the $63,350 is his gross income. Alright, now from that gross income, we want to come up with his adjusted gross income. So what we talked about before, the adjusted gross income is the gross income minus the adjustments, like the tax deferred savings plan. So for this man, because he did contribute to a tax deferred savings plan, we're going to take that $2,300 that it said that he contributed, and that's his adjusted gross income. All right, and then for part C, his taxable income. For his taxable income, we're going to take that answer to the last part, his adjusted gross income, and then subtract out any exemptions or deductions that he qualifies for. So he gets to take out his personal exemption, that $3,800, but he also gets to take out the standard deduction of $4,950 or his itemized deductions, whichever one's higher. And if you look at what it told us in there, he had the interest on his home mortgage was the $6,500. Right? He paid $2,100 in property taxes, right? And then $855 in the state taxes, and he contributed $3,000 to charity. So if you add all those up, you get $13,455, and since that's greater than that standard deduction, then it pays off for this guy to itemize. So he's going to get the $3,800 to determine his taxable income. We're going to start off with his adjusted gross income, take off the personal exemption, and then his itemized deduction were greater than the standard deduction. So we're going to take those both away, and there's his taxable income. Okay, so if you go back and look, he originally started off with $63,350 as his overall income, but the only part of that that's taxable is the $43,795. All right, this is a percent income tax table. It shows different tax rates, right, for the way that you're the 4 different filing statuses and the way that you're choosing to file your taxes, and then the tax rate at these different levels of income. All right, so for like our friend here who had a taxable income of $43,795, right, for the first $8,700 of that, he was single, so for the first $8,700 of that, we would tax it at 10%. Okay, now he's got more than that. Okay, he's got more than that. So $43,795. So for the next, from $8,701 to $3,550, we would tax that amount at 15%. Okay, and then for the last little bit of it, all the way up to his $43,795, he would be at this rate, right, up to the last little bit at the 25% rate. Okay, so that would be the taxes he would have to pay. And then there's standard deduction. Right, his itemized deductions were more. There's his personal exemption. Notice that's the same all the way across the board there. All right, but notice the numbers change a little bit at the higher levels of income. When we start filing married separately, like 2 people are married, but it's for sometimes in some situations it's cheaper for them to do their taxes separately. Married filing jointly, notice the numbers start changing. This is double this number, okay? And then head of household, all right, we see the numbers are changing. The tax rates themselves aren't, but you know what qualifies to get into those tax brackets does change for the different filing statuses. All right, and then these standard deductions are different in the married cases and head of household. All right, so here's an example. How do we come up with the income tax owed by this a single woman? She has no dependents. Okay, her gross income deductions and credits are given down here, and we want to use the marginal tax rates from this table over here. Okay, so this is her gross income. These are the adjustments and the tax credits. These are some deductions that she can take. All right, so with your deductions, you want to look to see if the sum of these are higher or less than the standard deduction, and we kind of see it's definitely going to be higher here for her, so it would be payoff for her to itemize. But let's go through and calculate what's taxable. So we take her gross income. Remember, we're going to take her gross income, subtract off the adjustments to get her adjusted gross income. So gross income minus the adjustments. There's her adjusted gross income. All right, and then from there we want to take off the determine the taxable income from her adjusted gross income. So she's got the $58,000 adjusted gross income. We'll start from there, and then we're going to take off her exemptions and deductions. Okay. Now, her exemptions and deductions, we got $58,000 that we're starting off with. We're going to subtract off the $3,800. These are her itemized deductions. All right. $7,500, $2,200. The medical expenses, you have to exceed, according to this, you have to exceed 7.5%. I believe it's all the way up to 10% now of your adjusted gross income, if I'm not mistaken. So at the time this was written, it was 7.5%. So her adjusted gross income was $5,800. 7.5% of that's $4,350. She did not exceed that, so she can't deduct that from her adjusted gross income to get her taxable income. But still, just the first three, just the very first mortgage interest itself is higher than the standard deduction. So it is going to be more beneficial for her to use an itemized return rather than a standard deduction. So we're going to take away $58,000 minus the $3,800 standard deduction, or the exemption that she's allowed to take, and then the $12,000 is going to be the itemized deduction that comes out of there. Okay, so we're going to take that off. There is her taxable income, so $42,100. Now the question said calculate the income tax. All right, the tax owed, not her taxable income, but the income tax owed. Different, completely different thing. So what we want to do is take the tax computation, okay, what we're going to get from our table, and we're going to subtract off her tax credits. All right, her tax credits $500. So where are we going to get this tax computation? Well, because this taxable income is $42,100, going back to this table, that means she's going to fall into this 25% tax bracket. Okay, but we have to build our way up to it. We're not just going to take the $42,000 and multiply by 25%. We've got to make it up by this table, how this table goes up a little bit at a time. So what we have to do is break it down into the three categories that she falls into. So this was the breakdown. This is why we're doing this on that table. 10% up to $8,700, 15% on the next amount of money, and then 25% on that last little bit where her $42,100 is going to end up. So we're going to end up with $42,100 is going to end up in this last group right here. So that's the three areas that are going to be used to come up with hers. All right, we don't need to go any higher than that on the table because her income, her taxable income, falls in this last group. So there's nothing left when we get done with that last group. Okay, so because she falls in this third group, we're going to be able to use all of these first two groups, okay, and then just part of this last group. So we're going to get 10% of that first $8,700. So 10% as a decimal is that, and we're going to get all $8,700 in that first group, okay. And then in the second group, we're going to multiply by 15%, okay, and we're going to get all of this as well. So we're going to take the $35,350, all of the highest amount, minus the $8,700 that we've already taxed. We've already taxed $8,700, so we're going to tax 15% at the high end here, minus the $8,700 that we've already taxed. All right, and then the last group, she didn't make this much. She was at $42,100. So we're going to tax at the 25% rate. We're going to tax the remaining amount, the $42,100 minus the amount we've already taxed up to that $35,350. So that's where this is coming from. Notice it's just all of this number right here times this rate, and then it's this upper number minus that previous amount at this rate, and then it's this upper number once we've substituted in, because she didn't make as much as the upper number here, it's this number minus the upper number from the previous bracket at that rate. That's where this is coming from. All right, and if you calculate that out, this minus this is a $26,650, and then this last amount that's at the 25% rate is $6,750. All right, and just notice too here, if I add up, let me put it right here, these three numbers that we're multiplying by these rates, the 8,700, the 26,650, and the 6,750, that adds up to her taxable income. It's just we're splitting apart at the three different brackets. So she falls in the 25% bracket. It doesn't all get taxed at the 25% bracket. We break it apart into the three different brackets that she falls into. Okay, so 870 is coming from the 10% bracket. Almost 4,000 is coming from the 15% bracket. The majority is coming from there. She just barely fell into this last bracket. So, but still, it was a high enough tax rate. That's still a big percent, a big chunks coming from there. Okay, but we see the 26,000. That the majority of her her taxable income is falling into that middle bracket. Just a small portion is falling into the last one. All right, but there is her taxable amount in the tax computation part, and then we minus the tax credits that she gets, and she is left to owe $6,055 in income tax. That's her calculation. All right, there's some other terminology from this section. Social Security, Medicare, FICA taxes, Federal Insurance Contributions Act. That's what the FICA abbreviation is actually standing for. So sometimes we have to pay FICA taxes, and not sometimes, everybody, and that's taxes that are used for Social Security and Medicare benefits. So it's basically paying for, that's what we're talking about, the health care for others and ourselves once we become retired. But a lot of that, a big chunk of that is used like right now for other programs and other people to use it at the moment that you're paying it. But eventually, as long as it doesn't completely go away, you'll get to use that benefit when you're older. All right, Medicare provides health coverage mostly to older citizens, but it does provide some for younger people and even small kids in some cases. All right, but anyway, there's some rates of that comes out for these FICA taxes. All right, and a lot of times your employer will match some of these for yourself. All right, if you're not self-employed, so you have a business that you work for, and you earn $150,000, what are your FICA taxes? So going back to here, so it's the first $110,000 at this rate, the remaining at this rate. So we're going to multiply that first $110,000 by this is a decimal 0.0565, and then the remaining amount, the remaining $40,000, gets hit at this amount. So the 0.0145, because we're going to write these as decimal. Remember, two places to the left when we change these percents to decimals, and then multiplying those out, this is the 6215, this multiplies to the 580, adding those two together, that gives me my FICA tax calculation. Okay, so just like with the income tax, so we need to break it apart if we go beyond that first amount with our income. All right, tax rates for a working student. So you want to have extra spending money, so you are going to work a part-time job in addition to your school. All right, the job pays $10 per hour, and you work 20 hours per week. All right, so 10 times 20 is 200. You're making $200 a week. Your employer is going to hold 10% of your gross pay for federal taxes, and then your 5.65% FICA taxes, 3% for state taxes. Part A, what's your weekly gross pay? So that's just your 20 hours per week, your $10 per hour. We don't have any other sources of income that are talking about in here, no wages or tips or any other interest income. So $200, 20 times 10 is your weekly gross pay. All right, how much of that $200 is withheld each week for federal taxes? Well, federal taxes right here, 10% of your weekly gross pay. So 10% of 200 is 20. All right, again, I can do that with a calculator. 10% as a decimal of 200. Remember, of, when we're dealing with percents means times, so 10% times 200 is 20 bucks. So 20 of that $200 is being held with the federal taxes. Right, how much is held for the federal programs, the FICA taxes? That's going to be 0.0565 times the $20, which is, oops, not $20, I'm sorry, 5.65 times the 200, the gross pay, which is $11.30. Okay, so there's our gross pay, there's our federal taxes, there's our FICA taxes. All right, how much is withheld for state taxes? 3% of that 200, so 0.03 is 3% of the 200 is withheld for state. And then what's your weekly net pay? Well, you got the $200, you got to take out the 20 for federal, you got to take out your $11.30 for your FICA, your $6 for the state. So you're going to bring home $162.70 is your weekly net pay. All right, and then the last part. What percent of your gross pay is withheld for state taxes? Well, this is what we took out for the taxes and all the different things that I didn't get to keep from my gross pay for that $37.30. So we're going to take that $37.30. You can also get that from the calculation we just did, minus 200. There's the $37.30. We're going to take that $37.30 divided by our gross pay. That's a decimal. To get it to a percent, oops, not times. To get it to a percent, we multiply by 100. All right, that moves the decimal point over 2 places. Just going from decimal to percent. So about 18.65, 18.7% is the percent of my gross pay that was withheld this period. So what does that mean I get to take home? We can also take our 100% and subtract out that 18.65 or 18.7. That's what I end up getting to bring home. That's actually a high percent, but with a part-time job, you're not going to fall up into a high tax bracket to where you you start seeing like 25 and 30% and higher of what you actually get taxed and don't get to take home. All right, but anyway, there's the section or some notes on income tax, and get in there and start practicing those problems. Some of these homework sets a little bit difficult and some time consuming to get these concepts down, the different names, the different ways you go about determining what falls into each bracket and everything.